Okay, good morning everybody. Welcome to my part of this course. So my part deals with asset pricing, as I have already told you in the beginning and the introduction meeting. And the paper that I would like to discuss with you today is entitled Replicating Anomalies. So first of all, what is an anomaly? So from your undergraduate studies, you might have heard about the size effect, about the Fama-MacBeth three-factor model, and about the value anomaly, right? So an anomaly is basically a zero-cost strategy where you short sell stocks, you take the money and you invest it in other stocks that your model predicts to outperform. Yeah? So you form a zero-cost strategy. And if you regress this zero-cost strategy on a pricing model, like the CAP-M, for instance, and the intercept in the regression remains significant, then you would call this as an anomaly. So that's a very simple definition, and there may be also other definitions and other pricing models, but that's in essence the idea. Yeah? You have a zero-cost strategy that gives you profits, and even after controlling for certain risk components. So what's going on in this paper here? So what the authors are doing is they replicate 452 different anomalies that have been reported in the finance literature and argue that 65 of these 452 anomalies are not able to be replicated. So they fail the replication. And they're talking about different t-values here in the paper. Yeah? So when they argue that 65% failed the replication, then they use the t-value of 1.96. And you might remember this from statistics classes. Yeah. We have a probability distribution, and you compare the t-statistic with the value of 1.96 or minus 1.96 as 95% of the probability mass is within these boundaries of the standard normal distribution. Yeah? And whenever the t-statistic of an anomaly is above 1.96, and if we apply standard theory, then we would argue that this anomaly is significant. And 65% of them are obviously have a t-statistic that is below this critical value of 1.96. And they argue also in the introduction that the main problem are microcaps. Yeah? And they talk about that they control for microcaps. Yeah? They talk about NYSE breakpoints and NYSE, RMAX, and NASDAQ breakpoints. So basically, I was supposed to read the paper like twice in order to understand what's actually going on here. So that's basically the way how they define microcaps. Yeah? So they say if we use the NYSE universe, so just NYSE stocks, let's denote this as our NYSE universe here, then everything that has a market cap that is below this 90% of the overall market capitalization, those are microcaps, those stocks. But if we use NYSE, RMAX, and NASDAQ stocks, then we have obviously more stocks in the sample, and our definition of microcaps is different. Yeah? So we would have more stocks in the microcaps category because we have simply more stocks. So that's basically only how when they argue they control for microcaps, it's just how they define them. Yeah? Because later on in the paper, they write that they have in their overall estimation, they have all the small stocks and the microcaps in the sample. So that's just the way how they refer to microcaps. Yeah? And later on in the paper, we will see that they basically, how they applied that. So there are 6 issues in this paper that are of importance. So first of all, we talked about that already, that 65% of these 452 anomalies, they fail the replication. Yeah? And the problem is microcaps. Microcaps represent only 3% of the aggregate market capitalization, but they comprise 60% of the stocks in numbers. Yeah? So the major part of the stocks are micro to small stocks, in essence. So, and they argue that many original studies, they overweight microcaps via equal-weighted returns, and often with MYSE, NASDAQ, and RMX breakpoints and portfolios. I don't know about that. So most papers that I read, they use value-weighted returns. So I don't know how they come up with this, but that's the way how they argue in their paper. Yeah. The second item here in this paper is that they adjust for multiple testing. Yeah? We have already seen, we talked about that just. If you, in standard statistic theory, we have these t values, we compare the t statistic with the values of 1.96 and minus 1.96. Yeah? But there's a paper that argued for that in finance, we should actually use different values. Yeah? It's not 1.96 anymore, it's 2.78. Yeah? And that's a problem because this is related to data mining, p-hacking, but we will talk about that later on. So if they account for this higher t statistic, or for this higher critical value that an anomaly should actually fulfill in order to be statistically significant, then there's even less anomalies that basically can be replicated. So the third point here is that their conclusions are not related to the extension of the data sample. So they also report the results for replicating the anomalies for the original sample, and the conclusions do not change. It's still 65% of the anomalies that cannot be replicated. Then they argue that the biggest cause for their results is the trading friction category. So basically what we will see later on is that actually none of the anomalies can be replicated. And then you may wonder, how is it possible that scientific research comes up with results and reports that certain strategies generate profits, and then in the end, if you basically estimate it one more time, you don't come up with any significant results. So that's a big problem, but we will talk later on about what all this is about. So how is the paper set up? So first of all, they report the results for the aggregated market, so for all anomalies together. Then they report the results for 6 different groups of anomaly. So they say, okay, this is one group of anomaly, this is another group of anomalies, and so they have 6 different groups of investment anomalies. And each group has about 40, 50 to 120 different anomalies. So, and then they report for each single anomaly of these groups the results. So that's the way how the paper is built up, and that's also the way how we will go through this paper. Then they argue that even those anomalies, obviously there are about 35% of anomalies that can be replicated or that have higher t statistics than these critical values here. And for those anomalies, the economic magnitude is lower than reported in the original studies. So that's now important, how they define a replication on page 3. So they argue here, they highlight a study or a paper from Fama-MacBeth from 2007, and there are 3 different categories of replication. Pure replication is redoing a prior study in exactly the same way. Then they talk about statistical replication. It's using the same empirical model, but different sample from the same underlying population. So scientific replication is different sample, different population, and similar but not identical statistical model. So, and in finance, the problem is in finance that finance and accounting is mostly observational in nature, they argue. And therefore, it's critical to evaluate the reliability of published papers. If they hold against similar but not exactly the same method. If you read papers nowadays, what you will see is that the main result is basically on the first 5 pages. And then you have 25 or 35 more pages where they perform different robustness checks. Yeah? This is because of all of that. Because you have to ensure that what you actually report is actually robust. Is robust against different kinds of methods. And also for your master thesis, that might be interesting to know. So whenever you deviate from simple OLS, then people get already suspicious. Because if you have a result and you have only a result because you have a very fancy method, then people might wonder, why is that? So then they continue in the paper about they refer to a paper from Harvey, Liu and Su, a 2016 paper, where they evaluate 296 different anomalies, and they report that 80 to 158 are likely false discoveries. So they do not exhibit significance after replication. So that's actually a strong statement if you say that, yeah, well, 60% of the people they just report lies. Yeah? It's of course a very strong statement here. So just think about it. And there are this p-hacking, or for why do we have? I mean, you might wonder, why do we have this higher threshold here? Instead of 1.96, we have 2.78. Why is that? So the problem is here is explained on page 5 in the paper and the first line. So first, it's difficult, if you do scientific research, it's difficult to publish a paper that has no results. Yeah? So, and at the same time, editors of journals, they want to publish papers that have a high impact, yeah, that are cited a lot. So that puts pressure on people who work in academia, on scientists. So scientists have to publish, first of all, they have to publish all the time. So it's a high volume, because if you don't publish enough, you're fired. So you have to publish all the time something, and then you have to have good results. Because you know that if you don't publish in a very good journal, at some point your contract will most likely end. Yeah? So there's a lot of pressure going on here in academia, and I'm happy that the authors in this paper actually talk about it. Yeah? It's actually the first paper that I see that actually openly talks about that. Yeah? So editors compete for citation-based impact factors and prefer to publish papers with most significant results. So what do you do in order to get significant results? So let's say you have an investment strategy, and it looks a little bit like this. Here's the timeline, T, and here is the price, depending on time T. So if you take the returns, then it looks a little bit like this. It's positive, and here it's negative. So if you take the whole sample, in the whole sample, you might have not significant results for your investment strategy. But if you take just a subsample, and then you argue in some way for why you just use this sample here, then your results will be significant. So what you do is you just report the results for this time period, and you get a high T statistic, and the paper gets published. All this is called p-hacking or data mining. And there are so many papers going on that this hurdle needs to be much, much higher than 1.96. So it needs to be, Harvey argues in his paper, it should be around between 2.78 and 3.39. Now your beliefs are most likely shaking. Your beliefs in scientific research. At least for me, when I was a master's student, everything what the professor were telling us was like the truth for me. But of course, nowadays I'm much more suspicious and critical. So that's also what you should become here. So and now the practical perspective. Now you can wonder, okay, so what? I will work in the industry. Why would I bother with all that? Well, there are obviously trillions of dollars invested in factor-based exchange-traded funds and quantitative hedge funds worldwide. So, of course, there's a huge practical importance for that. So, factor-based ETFs, of course, they invest in very similar strategies as we discuss here. They run value. You have an ETF that invests in momentum and all this and in small stocks. So you can basically, all these strategies are somehow used in the investment industry. So that's why it's also important from a practical point of view, at least for those of you who are interested in investment banking. And that's where you earn a lot of money, obviously. So the replication procedures are discussed in the second section here of this paper. We talked about that already. So 452 anomalies, and then they divided these 6 groups basically. So they have obviously 57 anomalies in the momentum group, 69 in the value versus growth group, 39 in the profitability group, and so on and so forth. So each group has a certain amount of individual anomalies. Then the data, they use standard data. So they use monthly returns from the Center for Research and Security Prices. So it's US data, obviously, and accounting information from CompuStat. So also for your master thesis, I always basically give the same advice. So whenever you deviate from the US market, you have to have a good reason for doing that. Because in the US market, there's the money, and in finance, we are interested in money. And whenever you deviate in the master thesis from exploring certain things in the US market, then you have to have a good motivation for why you do what you do. The Finnish evidence, it doesn't work out, okay? It simply doesn't make sense unless you have a very good reason for that. So, and usually in finance, you may wonder, okay, monthly data. If you read all these papers, like I would say 98% they use monthly data. Why is that? Who knows? It's like if you, since the 60s or the 70s, when finance research actually started, they use monthly data. So who knows why? Actually, it's a little bit out of date. We will see that later on. But also for your master thesis, if you use weekly data or daily data, then you have to have an argument for why you do what you do. But usually in finance, people still nowadays, in most of this papers that are published in these top journals, they use monthly data. So then they talk about what's different in their paper. So they exclude financial firms, but that's what all the papers are doing. Then they argue that some studies exclude stocks with prices per share lower than €1 or €5, but they account for all of these stocks. And now here they say it even. In particular, microcaps are included in their sample. And for each anomaly, how do they proceed? For each anomaly, they form deciles. So they use the whole universe of stocks, and then have certain characteristics. For instance, size, the market cap. Then they sort the whole universe of stocks into 10 different groups. Then they have the low group, the low market capitalization group, and the high group, the 10th group, where the market cap is high. They have this 10% of the highest of the biggest stocks. Then they buy group 10 and sell group 1. And they do this for all of the anomalies, irrespective on what is your sorting variable. It can be size, profitability, past returns, what we have in momentum, for instance, and so on. And then they also write about the data. If you have, for instance, if you sort with respect to size, then you use accounting data, and it's lagged. Of course, you have to make ensure that the data that you use is available for is public available for the investor. So they use lagged data. And also interesting that how they treat delisted returns, because for instance, if you have in your sample firms that go bankrupt, then you have to, of course, somehow to account for that. These stocks are delisted from the stock exchange, and you have to write. Also, if you have your master thesis, you have to write how you treat those firms. How do you account for the return of the delisted firm in your sample? So that's how they write it here. on page 7. For instance, if there's a value missing, they replace a delisting return with the mean of available delisting returns of the sample delisting type and stock exchange in the prior 60 months, and so on. They also talk about Winsorizing. Yeah, when they perform cross-sectional regressions, they Winsorize the sample of regressors. So you can easily do this also if you have Excel. Yeah, you have an Excel file. You have column A, column B. Yeah, and then you have here the data. Yeah, and then you have your dependent variable in column A and your independent variable, the regressor, in column B. And then you have this function in Excel that you sort with respect to, for instance, column B, where's the regressor. That's how they do it here. And then what you can do then is you can cut off the 1% highest and lowest observation from the sample. And then you perform the regression analysis based upon the smaller sample, like where you have cut off this extreme 1% in the upper and in the lower tail. Now you can easily do this in Excel, or you can prepare the data file in Excel and then upload it into eViews and do your analysis there. So that's Winsorizing. But what's the problem with Winsorized data? This is something that you should know from econometrics. What's the problem with Winsorized data? People don't talk about it, but it's still, if you have your observation points here, yeah, and then you have here some extremes going on. So your regression line will look something like this. If you take the whole data, and then you do Winsorizing, and you cut off these observations here, if you take them away, your regression line will look like this. So you have a systematic bias going on if you do Winsorizing. So when you do this kind of stuff, of course, you should then report both results, yeah, the Winsorized results and the ordinary results, because then people can have an idea about how much bias we have actually going on here. So, yeah, then they argue that they report the results for zero-cost portfolios using portfolio sorts, yeah, as we already discussed, and then they report the results for Fama-MacBeth cross-sectional regressions. Yeah. So, and then we will talk about how that looks like. So let's have as an example, let's talk about the momentum anomaly very briefly, just that you get an idea, because in this course you should obviously get a little bit knowledge of new methods, and you should get an overview about, maybe an idea for what you can do in your master's thesis, because all these papers that I go through, this is up-to-date research, it's the latest research in finance, and maybe some of you might get an idea of something interesting. So in momentum, if this is T0, this is T1, T minus 1, and so on, T minus 12. So for all stocks in your stock universe, you compound the cumulative return, for instance, from T minus 1 until T minus 12. Yeah? You cumulate the returns. Then you sort all stocks in your stock universe from highest to lowest cumulative return. You sell those stocks that have the lowest cumulative return over this period here, from T minus 1 until T minus 12, and you use the money and invest it in those stocks who have the highest cumulative return in the same sample period. And you keep those portfolios, those stocks, constant until T plus 1, and then you do it all over again. Yeah? Move the window 1 month forward, and then again you sort with respect to this cumulative return from T minus 1 until T minus 12. Yeah, this is standard momentum strategy. So in this file, I denoted the cumulative return as CR. So CR1 is the cumulative return over this sample here for the first stock. Yeah? That's in our regressor matrix X. So we have in the first column, we have a vector of 1s capturing the intercept, the regression intercept. And the second vector of our regressor matrix X captures this cumulative return in this period here. Yeah? Then we have the vector of independent variables, and if we have cross-section regressions, we have the first increment in our y vector are the excess returns of the first stock, and the last increment are the excess returns of the end of the last stock. If we have 10,000 stocks, then obviously we have a 10,000 by 1 vector. Yeah? And our X matrix will be 10,000 by 2. Yeah? So then we have we define a weighting matrix W, and it is basically it looks a little bit like an identity matrix, but it's not exactly an identity matrix. So what we do is we use an identity matrix which has only 1s on the main diagonal and 0s elsewhere, everywhere else, and then we put on the main diagonal. You can easily do this in a matrix program like in MATLAB. So we put on the main diagonal the market capitalization of the first stock divided by the total market capitalization in our sample. And the second element on the main diagonal at time t=1 is we use the market cap of the second stock divided by the total market cap. And we do this for all stocks. So this weighting matrix will be n by n, and if you have 10,000 stocks, 10,000 by 10,000. So that's all. After we have defined that, we can run the simple OLS regression, but we put in between this weighting matrix here. Yeah? It's x prime w times x prime, we invert this guy, times x prime w times y. What we get out is a 2 by 1 vector, because we have in our X matrix, obviously, we have here the first vector corresponds to the intercept term, second vector for this captures basically the predictability of these past cumulative returns. Do they have any predictive power for t+1? This is what we're interested in. So we take this vector here, this 2 by 1 vector, and put it into a matrix that we construct. So the first element in our matrix for time t=1 will be exactly the point estimates from our first regression at time t=1. After we completed that, we do the same again for time t=2. So then here will be the excess returns of our stocks on our sample for time t=2. And then we do the regression all over again. And we get new point estimates. Yeah? So, and we put it again into a new matrix here. So what we will get is for all, if we do this for capital T times, what we will get is a 2 by T matrix. Yeah? And what we do then is we just take this, what we don't have to do is we just take the T statistic of the average over this B1s. Because the B1s, what they tell us here in this setup here is if the exposure against this cumulative past return, if this is significant. So that's another way of how we can investigate if a characteristic has predictive power for future returns. Either we do portfolio sorts, as we just discussed here, or we do it via Fama-MacBeth regressions, where we put the characteristic that we think of has predictive power into the regressor matrix here. Yeah? And there are many different ways of how we can do Fama-MacBeth regression. This is just one out of many. Yeah? Last year in my MATLAB course, I was going through a different method. But in the paper, they use this method here. And I also argue that they use univariate Fama-MacBeth regressions exactly the way how we just discussed here, because using multivariate regressors here could poison. If we would here basically have more columns, it could poison the results because of multicollinearity. Yeah? If two regressors are insignificant, but they could be significant if you use them together because they are correlated. And this could poison the results. So that's why they use just univariate Fama-MacBeth regressions in their paper. Now the question is, okay, they argue in the paper they use value-weighted or weighted Fama-MacBeth regressions, and they use also this standard OLS method. So if you do the same thing here, and you exchange the weighting matrix by the identity matrix, yeah, where we have just once, we can also basically just delete this guy then here from this regression. So this is basically the way how it would work out if you use OLS Fama-MacBeth regressions in that paper. Yeah, you would just use the identity matrix here instead of this guy here, which is just once on the main diagonal, and this is the same as if you just would neglect from that matrix at all. Yeah, it's then just x prime x inverted times x prime y. That's it. So in the same manner, they do it basically for all of the other 452 anomalies. Yeah? Then you have just a different regressor here, obviously. This guy. It can be size, it can be the market cap, it can be the booked market ratio, and so on and so forth. So once again, when they talk about that they control for microcaps, either using NYSE breakpoints or NYSE, RMAX and NASDAQ breakpoints, it just means that they basically, how they refer or how they denote microcaps is different. But microcaps are still in the sample. So I think we have talked about it already. Let's go to table 1. There we have the first interesting results. So from table 1, what we learn is that that's on an aggregate number. Yeah? It's across the sample from 67 to 2016. Yeah? So across time, the number of firms in the overall US market was obviously 3,869. Yeah? And that's, of course, and they also, that's 100% of the overall market cap. So 2,365 of these firms are referred to microcaps according to that definition. And it corresponds to 3% of the market cap, whereas big firms correspond to 765 firms of these almost 4,000 firms, and they have a market cap of around 90%. Then they report the value-weighted returns and equal-weighted returns, and you see slightly differences. If you use value-weighted returns, the returns are always smaller than equal-weighted returns. Because if you use equal-weighted returns, you pay more attention to small stocks. Yeah? So let's say you have a small stock that has 1% payoff, and you have a big stock that gives you 3%, or it's the other way around. The big stock gives you 1%, and the small stock should give you 3%. So if you take the average return, or the equal-weighted return is 0.5 times 3% plus 0.5 times 1%, what you get is then 2%. That's the equal-weighted payoff. If you take, now let's assume the small stock has just 10% of the market cap and the big stock has 90%. Or you can, in absolute numbers, this is maybe 900 and this is then 100. So, and if you choose then, if you would compound the value-weighted return, it's then obviously 0.9 times 1% plus 0.1 times 1%, times 3%, sorry. So what you would get is then 0.9 plus is then 1.2, right? For the value-weighted return. So the equal-weighted return is always higher than the value-weighted return. So what you see also here from in the last column they report the cross-sectional standard deviation of return. So what's cross-sectional standard deviation? So I have defined you the concept here above. So we have R denotes the returns of stock I at time t, and capital E is the expectation operator. Yeah? The cross-sectional standard deviation, or the cross-sectional variance, this is the standard deviation is just the square root out of it, obviously. So you see in the upper line, the variance of Ri is the expectation over time. Yeah? There's this small t at the expectation operator. And then you basically, if you take it in discrete time, we can write for the first equation it's 1 over t, and then we have the sum sign from t is 1 to capital T. We have the return I t minus the mean of stock I squared. So that's basically the counterpart if you have discrete data. And for the second, we take the average over n, and the sum sign runs from I is 1 to n. And then it's the average over t. So in the first, we take the standard, or we take the variance in the time dimension of asset I, and the second, we take it in the for each point in time t, we take standard deviation over the assets. The cross-sectional standard deviation is the standard deviation across the assets for each point in time. So these are two different concepts, but they are related. So if you take basically, if you compound the realized volatility of a stock index of the, let's say, the S&P 500, and you plot it against the VIX, you will see that they're co-moving, or they're highly correlated. So these concepts are closely related to each other. And what you see here is that the cross-sectional standard deviation is the lowest for big stocks and the largest for microcaps, which is not surprising, right? So which means that the uncertainty in the microcap universe is much higher than the uncertainty in the big cap universe. Then in these figures A, B, C, what we see is that in the mid-80s, 70% of the stocks in the US have been microcaps. And nowadays, it's only about 50%. Yeah? So it has decreased. This is what we see in panel A, or in figure A. Figure B, what we see is that in the mid-80s, about 6% of the market cap belonged to microcaps, and nowadays, in the end of the sample, it's only 2% of the market cap. But now we remember in the introduction of the paper, they were talking about 3.2%, and that's the average across time. Yeah? But now we are at 2% nowadays. 2% of the market cap belong to or is comprised by microcaps. And also what you see is in the data, you see there's a trend. Yeah? So less and less percent of the stocks of the market cap belongs to microcaps. And in the last figure, what we see is that even microcaps become bigger. So nowadays, microcap has about 0.5 billion market capitalization. Yeah, so the market capitalization of microcaps has huge increase over time. So firms are becoming bigger and bigger. So what we see in table 2, which is the next interesting table, it reports portfolio weights on microcaps and investment capacity. over the sample period. Yeah? So what we see is if we check the column on the left-hand side, yeah, if we now consider the whole universe of these anomalies, and we consider NYSE breakpoints and equal weighted returns, what we see is that 55% are invested in small stocks. And that's that's obviously low, so this is basically the short side. And on the long leg, it's 59.5% are invested in these microcaps. If we use value-weighted returns and all stocks, and considering again the NYSE breakpoints, we have only 7.19% invested in microcaps on the short leg and 10.12% on the long leg. So what does that mean? So can you actually trade microcaps? What's the problem with microcaps? What's the problem with stocks that have a very low market capitalization? Obviously, you have a liquidity problem, and so it might be difficult to realize those profits. That's why you basically prefer to invest in big stocks, because the liquidity is not much higher. Now they're talking in section 233, they're talking about limitations, because, basically they argue, yeah, microcaps, you cannot actually use them, and so on and so forth. But here they write that a large fraction of aggregate employment resides in microcaps. So, for example, firms with less than 50 employees contribute to more than 30% of the total employment. So obviously, microcaps are, from an economic point of view, importance. Yeah. So now the big picture here in section 3. Let's go directly to figure 2. So now they report the results for the aggregation, so for all anomalies together. Yeah? So on the left-hand side, figure A, they report the results for the extended sample, and on the right-hand side, they report the results of the replication for the original sample, yeah? Using the data for the original sample. So what we see is here, again, using NYSE breakpoints and equal weighted returns, so 56%, or was it 58? I think it's 56%, but it doesn't matter anyways. So 56% can be replicated using the t-statistic of 1.96. Yeah? Using a t-statistic of 2.78, only 46% can be replicated using equal weighted returns and NYSE breakpoints. If we now would use value-weighted returns and NYSE breakpoints, only 35% can be replicated. And that's the figure that they talk about in the introduction, yeah? When they argue that only 65%, that 65% fail the replication. That's now basically the corresponding figure to that. So if we use NYSE stocks and value-weighted returns, and the higher t-statistic, yeah, due to p-hacking and so on and so forth, of 2.78, we see that only 17.9% can be successfully replicated. And if we argue that 80%, if we can replicate 80%, that's already a success. Then we see from the extended sample that irrespective of what breakpoints we use or what method we use, all of them are below 80%. So we cannot replicate those anomalies successfully if we consider the whole sample of anomalies. And if we consider now the original sample, the results don't change. Yeah? They are very, very similar. The figures are very, very similar. So this tells us already that the results are not driven by an expanded sample. What they do next is, now they want to break down the results for the whole sample of anomalies to the 6 different groups. We have 6 different subgroups of investment anomalies, like momentum, value versus growth, profitability, intangibles, trading frictions, and we know that in each of these groups we have like 50 to 100 single anomalies. But now we break it down to different major groups and see how it looks like there. And this is what we see here in figure 3. Yeah. So panel A reports the results for momentum, incorporating 57 anomalies. Panel B for value versus growth, incorporating 69 different anomalies. Panel C for the investment group, which is then the average here of 38 different anomalies. Panel D, profitability group. Panel E, intangibles. And panel F, trading frictions. So what we see from panel A. Panel A, if we use NYSE stocks and equal weighted returns, about 84% of these momentum anomalies can be successfully replicated. If we use this t statistic of 1.96, if we use the higher t statistic of 2.78, it's still 78% of the momentum anomalies that can be replicated, that have a higher t statistic than 2.78. So if we use NYSE stocks and value-weighted returns, which is the upper part in panel A, so the first line there, it's slightly lower, but it's still high. The same is true for investment. Yeah? So it's above 80%. It's 87% for investment if we use NYSE breakpoints and equal weighted returns, and the t statistic of 1.96. If we use 2.78 as t statistic, it drops slightly to 94%, 94.7. But the figures are still high. So what we basically, the overall view here is that momentum anomalies and investment anomalies, they actually can be replicated. So these are actually stable patterns, obviously, in cross-sectional returns, and they hold the replication. But in the category D, E, and F, where we have intangibles, trading frictions, and profitability, the replication success is pretty poor, because whatever method we use and whatever sample we use, or however we define our microcap category, all of them are below 80%. So successful replication fails for group D, E, and F. So obviously the major driver of the results reported in figure 2 are obviously the categories D, E, and F, which are profitability anomalies, intangible anomalies, and trading friction anomalies. And now they go from the groups to the individual anomalies. And there we will just go through some of them, because they obviously, this paper has 113 pages or something. So of course we will not go, we don't have the time and the willingness to go through all of them. We will just grab some of those that I think are interesting. And of course, everything that I do not talk about here in this lecture is also obviously not very important for the exam. Yeah? So that's, of course, the way how it is. It's fair play here. So if I jump over a certain table or something, then it's obviously not so important for the exam. Very simple. So let's go directly to momentum, because obviously if you see on my university webpage, I have published many papers that are related to momentum, because I think it's quite interesting, and obviously also it can be successful replicated across different samples and across different markets as well. So they write here in section 3.2.1, price momentum fares well in the replication, in particular the high minus low decile on the prior 6 month return with the 6 month horizon, earns on average 0.82% per month with a t-statistic of 3.5. 3.5 is higher than 2.78. Yeah? So it's a successful anomaly using NYSE breakpoints and evaluated returns. This estimate is smaller than 1.1% as reported in Digalis and Titzman in the original study. They reproduce an estimate using all stocks and equal weighted return in the original sample and obtain 1.18 and so on and so forth. So let's look directly in table 3. So this is basically what we were just talking about. Yeah, price momentum, prior 6 month returns, 1, 6, and 12 months. R to the power of 6 and 6. This is basically 6 months. They accumulate the returns basically from t-1 to t-6 and keep it 6 months ahead. And then they take the average return about this 6 months holding period. Yeah. So this is what they were talking about. The point estimate, what you see here, is 0.82% per month on average, t-statistic of 3.5 using value-weighted returns, yeah? NYSE breakpoints and value-weighted returns. Using equal-weighted returns and NYSE breakpoints, the point estimate is 0.64% per month with a t-statistic of 2.9. 2.9 is still above 2.78, obviously, so significant, even if you account for multiple testing. So, and if you just see here, it looks quite well. If you see just here on the left-hand side, so the t-statistics are high and significant, and indicating significant. And the same is true also if you check other momentum strategies here, you see similar patterns. Yeah? The next single anomaly that we would like to check is the book-to-market equity, yeah? the value anomaly basically. So you might remember from your undergraduate studies how this looks like. So we are in July at time t, and then we start to predict returns until June next year based upon data that we have in January available. And in January, it comprises the period t-1. So it's at least 6 months old data that we have for the construction of our portfolios. So it's a different strategy than the momentum anomaly. If we run momentum, we update it at the beginning of each month. So it's always, it's a rolling time window. It's always up to date basically. If you implement the value strategy, it's a huge time lag going on. Yeah? This time lag is much bigger or larger than for momentum. Yeah? It's more than 6 months old data. Because we have to look at the balance sheets of these companies. So what we see here is the value factor or the value anomaly using NYSE breakpoints and value-weighted returns generates 0.54% per month payoff, t-statistic of 2.61. So using the standard t-test of 1.96, it's significant and almost significant if we use basically this higher t-statistic of 2.78. Yeah? Using equal-weighted returns and NYSE breakpoints, payoff is 1.19, it's much higher, twice as high, and the t-statistic is 6.08, which is much larger than 2.78, indicating significance. So obviously, this strategy works also out very well. If we now move on, we have now investment to assets. So that's a strategy similar to the value strategy in the sense that they use like old data, old accounting data, it's lag data. So this strategy is is buying those companies that experience high asset growth, and they sell this position by stocks over companies that have experienced low growth in total assets. Yeah? The payoff is negative, which is the paper is about the asset growth anomaly. In the risk factor model from Fama and French, what we will discuss later on, they switch the long and short leg, so that the payoff is positive. So the investment factor is based upon stocks that buy those companies that had a low asset growth and sell stock short that have a high asset growth. So then it becomes, of course, they just switch long and short leg. But here, it's a strategy, obviously, that is invested in companies that have experienced high asset growth in the previous period. So the payoff is negative, t-statistic 2.89, using NYSE stocks, breakpoints, and value-weighted returns. And if we use equal-weighted returns, it's even higher. It's minus 1.02% per month with a t-statistic of 6.91. Now we have another anomaly that we're interested in. It's operating profit to book equity. This is used as a profitability factor in the Fama and French risk factor model that we will discuss at a later stage. So what they do, this anomaly or this risk factor is long on companies that have a high operating profitability in the previous period, and it finances this position by shorting stocks that have a low operating profitability in the previous period. The spread using NYSE breakpoints and value-weighted returns is 0.27% per month with a t-statistic of 1.34, which is obviously below this critical value of 1.96, implying that this anomaly cannot be replicated. It fails the replication. Also, if we use equal-weighted returns and NYSE breakpoints, the payoff is even lower, which is a little bit awkward, right? 0.13, and the t-statistic is 0.66, implying again that it fails successful replication. And now we can go through all of the anomalies and investigate just the t-statistics. Yeah? How do they perform in the replication? So finally, the last interesting table is table 4. So in panel B, they report the correlations across these different categories of anomalies. For instance, the correlation of momentum anomalies and value versus growth anomalies is negative. It's minus 0.17. Whereas the correlation across momentum anomalies is 0.39, which means they're co-moving, right? Also, the correlation of among the value anomalies is 0.6, which also implies that the anomalies in this category, value versus growth, are co-moving, so they are highly correlated with each other. Which means somehow that obviously there might be a common source that drives these anomalies. And what they do in panel C is they want to see if each of these anomalies, if they have a common driver, because the ex-ante categorization of 6 different groups, so they want to investigate if it makes sense to divide these anomalies in these 6 groups. And it would make sense if they have a common source of risk, or if they have a common driver, if they are which means that they would be highly correlated, right? So, and a statistical method to investigate these is principal component analysis. So we will talk about this in detail in the exercises, because it's a little bit more, it takes a little bit more time But the idea is, let's say we have a universe of 10 different anomalies. Yeah? And we compound the covariance matrix. First of all, we standardize each time series to have a zero mean and a variance of 1. What you do is you take, for each observation, you subtract the sample mean and divide it by the standard deviation. You know this from statistics class, right? So you normalize each time series. So then you use this covariance, then you compound the covariance matrix of these 10 standardized series, and you compound the eigenvalues. So you have 10 different anomalies, which means you have you have also 10 eigenvalues. So if they are completely uncorrelated, so if these anomalies have nothing to do with each other, each eigenvalue would have a value of 1. But let's assume you do the eigenvalue analysis and one of the eigenvalues has a value of 5, which means that the first eigenvalue, which is the first principal component, would explain 50% of the whole covariance matrix. And the other 9 eigenvalues would be obviously smaller than 1, right? So the others would explain less. So in this case, we could argue that, yeah, there's one common source of risks, of risk that basically drives these 10 different anomalies in the same direction. This is very simple explained how it works out, but we'll do it, as I told you, in detail in the exercise session. So if we just look at the first group, which is momentum, and then they report the first 10 principal components. So we know in the momentum category have been, was it 56? So we have 56 eigenvalues, but they just report the first 10. So the first eigenvalue for this momentum category explains 53.16% of the covariance matrix. So it's slightly more than half of it, which implies that there is a common source of risk, like a common driver. For the second group, value versus growth, it's even higher. It's 59.8%. And the same is also for profitability and for the trading fiction category. It's above 50%. So the first eigenvalue explains more than 50% of the covariance matrix, which implies there's a common source of driver. And that's why they argue, yeah, that the ex-ante categorization, if it really has been ex-ante, I don't know, but at least they say so. So that the ex-ante categorization actually makes sense, yeah, because most of those categories have a common source of risk. And principal component analysis is something that you can also use in many different settings. So there are many different papers in finance and also in other types of scientific research, which all use the same methodology. So I think that's this paper here. Are there any questions? I think the conclusions are clear. They argue that 65% of these anomalies fail the replication. So 65% of these 450 anomalies cannot be replicated. And the reasons for that is that probably people are too eager to publish results because they get pressure that they have to publish all the time, and the editors are competing for impact papers that get citations. So it's a bad circle going on. If there are no questions, I would like to go through the next paper briefly. That is on the reading list. And the paper is entitled, let me see, Cryptocurrencies and Momentum. This paper is co-authored with my colleague, Niranjan Sapkota. What we do in this paper is we retrieve a sample of 143 cryptocurrencies over the sample period from 2014 to 2018. All of those have a proof of work consensus protocol, and which makes sense obviously because until 2014 most of the cryptocurrencies had proof of work consensus protocol. Only a few, 3 or 4 or something, they had proof of stake consensus protocol, but we excluded those from the sample. And we used monthly data of those cryptocurrencies over the sample period 2014-2018, and we implemented different momentum trading strategies. Does anyone here not know what a cryptocurrency is? You know what Bitcoin is, right? So that's obviously common knowledge. So cryptocurrencies are it's a new asset class, obviously, if you want to see it like that. So some people see it as a medium of exchange for value. Yeah, instead of using euro, you could think about using cryptocurrencies, cryptovaluta. There are many different types of cryptocurrencies. So I told you already, you can distinguish between the consensus protocol, if it's proof of work, proof of stake, or hybrid. You can divide cryptocurrencies into this anonymous coins and non-anonymous coins. So obviously, if you use Bitcoin, you can trace your wallet, so it's public knowledge. People know where the money transfer or the cryptovaluta transfer takes place, into which you can basically trace the IP address. And but this is not anymore possible if you have anonymous coins. So there you cannot trace back where the money flow goes, which is obviously for the tax authorities a big problem, and also it's a good thing for people who are exposed to criminal activity. So there was obviously in Norway a case where someone took someone else in prison, and then they wanted to have money in a big amount of money in a certain cryptocurrency that was anonymous. So people and the police couldn't trace it back. So it's obviously also a problem. These cryptocurrencies have obviously some advantages, but on the other hand also disadvantages. And people are interested in this kind of research nowadays. And the good thing is for you, obviously, students always come to me and say, yeah, I don't know. I mean, don't have an idea. It's so difficult to come up with a new research idea and yada, yada, yada. And well, I mean, here are many research ideas, obviously. It's a very, very new field of research. There are many ideas that you can come up with and many things that you can do. You have no data problem, obviously, because the data is public available in the internet at CoinMarketCap. You have the whole crypto data. You can get it for free from the internet. So it's easily accessible. The only thing that you have to do is you have to get yourself familiar with that stuff. But this is what you have to do anyways. For a master's thesis, you have to have a topic and you have to make yourself familiar with the topic, figuring out the gap, and finding a gap in cryptocurrency research is very easy, obviously. So we investigate just these cryptocurrencies that are denoted as coins, so those who are basically used as for transfer of value. There are also other cryptocurrencies. They are called utility tokens, which are used for business renewal, I would say. If you have a project, if you go to a bank, if you have a project idea and you want to run a business, and you can go to a bank and try to issue some stocks, running a stock company, probably the bank will say no, but you can take the alternative and you can make instead of an IPO, you choose an ICO, and what you issue is you issue your utility tokens, and you get from your investors cryptocurrency in return. There was a Finnish company called Dent, which raised millions of dollars by doing this. It was a very successful company. They raised a lot of money via this cryptocurrency market, And yeah, you can use this money for financing your business idea. So, but in our study, we don't use utility tokens, we just use these coins, and in order to have a sort of a homogeneous sample. Yeah. So in our study, we replicated the standard momentum strategy, like documented first in this paper from Jäger and Titzmann, this 93 paper, and we also implemented time series momentum, which is a newer strategy. Yeah, it's proposed from Moskowitz, I think, 2012 paper, because in time series momentum you invest in the whole universe of assets. Yeah? If you use the standard momentum or this cross-sectional momentum, you have a long and a short leg, so you skip basically, if you have these sides, you skip 80% of the stocks. You just buy this 10% highest and sell 10% lowest. Yeah? But if you have time series momentum, you invest in all of them. Yeah? If the cumulative return is positive in the accumulation period, then you invest. If it's negative, you sell this asset. Yeah? So it's a little bit different strategy. But of course, they're highly correlated. So if you read the literature related to the new cryptocurrency literature, you will see that there is no consensus achieved yet. Some papers will tell you that, yeah, the cryptocurrency market is very efficient. It's more efficient than other asset markets. But there's also other literature which tells you exactly the opposite, yeah? That this market is inefficient. So if you implement momentum and it works out, then we would obviously support the literature that tells you that the market is inefficient, yeah? Because past prices would predict future information, future payoffs. So, and if momentum does not work out, our study would support the literature telling you that the cryptocurrency market is efficient and more efficient than other asset markets. So this was a good thing with this paper the idea with this paper was, whatever comes out, we either support one or the other stream of research. So it's what comes out didn't matter for us. But it turns out that this doesn't work out. So when we implemented this momentum strategy, and we see on the left-hand side the strategy 12-1-1 means, okay, we cumulate from t-1 to t-12 the returns, and then we keep it 1 month ahead. 12-1-1, we skip 1 month and keep it 1 month ahead. 6-1-1 means, okay, we go to t-1 and cumulate the returns until t-6. We skip 1 month and keep it 1 month. 1-0-1 means, okay, we cumulate the returns from the previous month to now and keep it 1 month. We don't skip any month. So it's always the cumulation period, skipping period, and the forecast period. So what we see here is from table 1 that most of these momentum strategies, the payoff is not significant. So momentum does obviously not work out. The only strategy that appears to generate payoffs is the strategy based upon cumulating on the previous month and having no skipping months. So this generates a payoff of, in our sample, of minus 14.87. And this is what we used here, trimmed data. So which means we excluded the highest and the lowest return in the sample period. So obviously, implementing momentum in the cryptocurrency market does not seem to pay off. So in table 2, we report the results using just those 30 cryptocurrencies that have the highest market capitalization, and we rerun our estimates. And what you see here is also there's usually no payoff. Only if there's one strategy, yeah, because we have 5 groups, and usually we would buy the 5th group and sell the 1st group, but we also implement a strategy where we tighten the spread, so we buy the 4th group and sell the 2nd group, yeah? Because we wanted to see, okay, how does it perform if we implement this strategy not in this most extreme group, but in between. And then there was one strategy that obviously paid off here, also negative, minus 17, with a t-statistic of minus 1.78, which indicates marginal significance only. But in essence, what we have here is a non-result. Yeah? So we do not find evidence for this standard momentum strategy. Yeah? Here we report in figure 1, we report the time series evolutions of time series momentum strategies, yeah, using only the previous month or the last 6 months or the last 12 months. So what we see here is in the beginning of the sample, there's zero payoff, and then in the end, in 2017, all of a sudden, the payoffs go up like a rocket, and this was the time when the whole cryptocurrency market actually exploded. We had a huge bubble going on. In 2017, all cryptocurrencies increased in prices, and then they were falling again. So this was a bubble formation, obviously, what we have experienced. And but momentum payoffs are close to 0. These payoffs just happen to coincide with the bubble formation in the general cryptocurrency market. So in this paper, we used monthly data. Yeah, because I told you already in the beginning that in finance, we usually use monthly data. But if you use weekly data, the results will change. So we have my colleague and me, we have been working on a paper where we use weekly data, and we were investigating a similar sample. I think it was about 4 or 5 years of weekly data, and we were forming portfolios of cryptocurrencies with respect to the energy consumption. So proof of work consensus protocol is high energy consuming. Yeah? So for instance, Bitcoin, you might have read it also somewhere in the news, that the energy consumption to maintain Bitcoin is roughly as much as Denmark. Right? So it's a problem, yeah, that the maintenance, that this mining of cryptocurrencies is so energy consuming, and energy is obviously a rare resource in our economy. So the proof of work consensus protocol, where people compete for the mining, yeah, it's a high energy consuming process, and you can divide the cryptocurrencies into those who incorporate this proof of work consensus protocol. They are high energy consuming. Then we have the proof of stake consensus protocol. They are low energy consuming because people don't compete, they cooperate. Yeah? So everybody, and if you do this mining, all people are mining, and everybody gets the coins that are related to the stake that they hold on that specific crypto valuta. So, and then we have this sort of hybrid coins. They are in between. They are like medium energy consuming. So because this is a mixture of proof of work and proof of stake consensus protocol. So we have 3 different energy groups: high, medium, and low, and we compounded autocorrelation functions. So we were up to, let's say, 5 legs. And what we figured out was that actually these cryptocurrencies using weekly data are highly autocorrelated. Autocorrelation means momentum works out. It's a rule of thumb, okay? If we have positive autocorrelation in the data, it means past return predict future return, which means momentum works out. So we implemented time series momentum strategy for these different portfolios, and we figured out using weekly data, and if we use 12 weeks, which is in essence 3 months, if we cumulate returns based upon the last 12 weeks, they predict returns. So, and this payoff is significant. That's just side information. Maybe for some of you think this might be of interest for the master thesis. So, if there are no more questions for these two papers that we went through today, then I think we can end this session.